Welcome back to your Mortgage Insider Update this week. Welcome to August. We have been welcomed by a downgrade of U.S. debt by Fitch Rating Services 12 years after the S&P rating service had already downgraded from AAA to AA status the U.S. debt. Fitch is just now getting around to it. So we're not sure if they see something that we don't see in the economy, but that is definitely driving up lending costs this week. Treasuries are up. We're going to take a look right now. As of hump day, we've got the 10-year Treasury going up the last 2 days, back over 4%. We scroll down to look, the 10-year hit this level just a couple weeks ago. We were talking about on July 9th or 7th, Friday the 7th and the 10th, that Monday, had a spike, hit the spike, basically peaked, and came down nicely with the 10-year Treasury yields. Now, this does reflect longer-term interest rates like mortgage bonds, so we're going to take just a look at the trend here. We can see the 25-day average. We had fallen below the 25-day average, inched our way back up, and just took a stair step in the last few days as this new news has come out on the AAA rating being reduced to a AA rating by Fitch. That is one of many factors. Unemployment rates have come out with ADP announcing 360 some odd thousand jobs created in the private sector last month. So that's for July. We'll get the government number on Friday. Let's take a look at the mortgage-backed securities. So 5.5% coupon on mortgage-backed securities. This would work the exact opposite. So we saw back the early part of July, the price hit its low points. That meant the interest rates were at their highest point on as far as the bond price as it sells. So we bounced nicely back above that. And then today we're seeing that not quite as exhausted as a move. The 10-year Treasury is directly impacted by this that is U.S. debt, right? So we can see that that's hit a high point. The 2-year has hit a high point. Mortgage-backed securities have initially really been pulled back. We saw a lock alert early this morning. Things have calmed down. We'll see as things lay out. We will get more reports on weekly unemployment, who's filed for unemployment on Thursday. But Friday is the big jobs report from the Bureau of Labor Statistics. That's what we'll be watching for. We do see the S&P 500 is down today. Don't usually talk about the stock market, but just a huge run on stocks. So I'm going to go back 6 months on the stock market, and you can just see the S&P 500 has been on a tear, consistently higher just until just this week. We've finally seen this turnover, still not below the 25-day average, so stocks could very easily turn around with more. So we're keeping an eye out for the Friday report, and we'll get back to you on an update next week. You can see that things are still volatile. The Federal Reserve did raise interest rates just last week. They are going to be on an 8-week hiatus, so middle of September before we see the next potential rate move. Many are already talking about a pause or a skip again. A little bit too early to tell. We do have 2 months of data to come out. So this first month coming out right now, July information, July reports. We'll get a CPI report of the next week along with producer price index, and at the end of the month, PCE. So still a lot of reports to come out over the month of August and even in early September before the next Fed meeting. So we'll hope for a softer economy, not a crashing economy. We'd like to see things slow down slowly but surely and keep this boat moving forward. Have a great week.